Welcome to 360 Money Matters, where financial planners Billy and Andrew talk all things financial planning. This podcast aims to increase your knowledge and confidence with all things money. Each week, they will cover topics such as investing, cash flow, budgeting, saving, passive income, debt management, and much more, so you can live a life on your terms without limits.
Hello and welcome back to another episode of the 360 Money Matters podcast. I'm Billy and I'm joined by my co-host,
Andrew. Bills, here we are back again for another podcast episode.
Andrew, we are back again for another podcast episode, week in, week out. Favourite part of the week for us. So
Exactly right. Although we are coming to the end of the podcast episodes for the year. So I think this might be our last one or either our second last one before we close it out and see everyone back again in 2024.
Well, if it is our last one or if it's not, there's plenty to go back on because I think we're at episode 116 or 17 or 120 or something like that.
119.
There we go, see? And if people are going to miss us over the Christmas break, then, good opportunities to go back all the way back to episode 1.
and then start it all over again.
All over again.
It's like your favourite show, right? You finish it and then you just start back up again and rewatch the all of the seasons back again.
That's it. Anyway, enough of us talking rubbish. Andrew, what are we talking to everybody about today?
So today we're talking about investment bonds. This is one of the things that we find is really underutilized from an investment perspective. Most people have never even heard of it before. And you consider, most people thinking about, potentially opening up trusts and doing things like that to minimize their tax. And there's this really fantastic vehicle from a, tax perspective that every time we talk to someone about, they've just never heard of it. So going to do a deeper dive into investment bonds, what they are, how it works, and how it might be beneficial for your own financial situation.
So just on this one, just want to make it clear. So we're talking about a investment product, but more so not specifically a particular product, more of a product class.
Correct.
What are the benefits? What are the features? What are some of the limitations? And doing a deeper dive on that. But essentially, what are we looking at here? We're talking about an investment vehicle that still gives you access to a range of investments that you'd get in, I guess, almost any other circumstance, if you decided to go directly and invest in something. But this is a different, I guess, legal structure that has certain features, which is really the benefits that we're going to get into and how we sort of go about thinking about that. But anyway, Andrew, that's kind of, I guess the broad brush statement. Let's get into some details and tell everybody what we're thinking.
Yeah, look, so an investment bond, they've previously been known, or not previously, but different product providers will call them different names. Yep. Some are, insurance bonds, growth bonds, education bonds. Yep. But in essence, what it is it's a tax-effective vehicle to invest your money. And going into some of the specifics around, what does tax-effective mean? Well, let's say some money is invested in an investment bond. All of the income associated with it gets paid within the bond. So it doesn't impact your personal tax return. All of the income is paid within the bond in a financial year. And where the income would normally be taxed at your marginal rate of tax, if you were holding that investment individually, it would be capped at a 30% tax rate. So you're never paying any more than 30%. So you consider the majority of people are on a 32%, 37%, or even a 47% taxable income. There's an initial tax saving just there in the form of the income that's associated with those investments. Take some franking credits and things like that, then you're dropping the tax rate down even further. But headline is income is capped at 30%. Where the real kicker is you hold the asset for longer than 10 years, which is generally how long people are holding investment bonds for, and there is zero capital gains tax paid on the sale of those assets.
Hang on.
He does this every time we say zero tax environment.
Yeah, we should. We need like a certain button that we can press that has like some sort of sound.
Yeah, exactly right.
But, Andrew, say that again.
So you hold an asset or you hold an investment bond for longer than 10 years. Once you sell the asset and take those funds, there is zero capital gains tax.
Just thought we'd pause there for dramatic dramatic effect. So from I guess from our perspective, from a planning point of view, when we're looking at this, and automatically we see, one particular thing that we look at is if you're a high income earner, being able to invest in an investment that doesn't then get added to your taxable income, and it is taxed at 30%, which is, if that's lower than your income, there's a tax arbitrage opportunity there. So from our perspective, we see this as a great opportunity if you're a higher income earner to be able to invest some money into a lower tax environment, which is great. There is that 10-year rule that Andrew was talking about. So in order for the bond to be able to have that tax effective status from a capital gains tax perspective, you need to hold the bond for at least 10 years or greater before you decide to withdraw, which, it's important to point out the limitations associated with that. It doesn't mean that you can't get your money out, because if you wanted to, or something happened and you needed to get it out beforehand, you can. So it's not like it's stuck in there. It just loses that tax effectiveness. Yeah. So the way that we tend to look at it is we apply a minimum 10-year time frame. And the positive side and the positive aspect of that is the compounding impact of having money essentially locked away for at least a period of 10 years.
Yeah. And look, you don't want to utilize it for this purpose because, the main attraction or the main driver of going into this form of investment is for the purposes of tax. But you consider it and say, okay, but 10 years is a really long time. What's going to happen in 10 years' time? Am I, going to need the money within there? Am I going to pull the money out and need to put it on a, deposit for a house or whatever it is? Let's say that you do decide to draw the funds out early. Well, you're no worse off than had you just invested that money in your own personal name. And so from a tax perspective, even though there are some limitations which we'll touch on, just having the opportunity for the tax benefit is very substantial in the fact that even if, there are some dramatic changes to lifestyle, there are some dramatic changes to your circumstances and you need to draw down on it early, it's not like you're all of a sudden being kicked up to top marginal tax rate and all of a sudden, you're in a worse position than what you otherwise would have been. You're just in the same position as what you otherwise would have been if it was an individual investment. Yeah.
And I guess two things that I'd like to point out in terms of the benefits associated with it. So just to be clear, to reiterate your point earlier, is it does not form part of your assessable income. So when you do your tax return each and every year, and even in the year that you do make the withdrawal, it doesn't even hit your tax return. It doesn't form part of it, which is great. So from a simplicity perspective, there's no additional reporting that you need to do like other investments and add that as part of your income.
Yeah, so it doesn't increase your tax bill to your accountants or whatnot. Because there isn't any additional work in managing any of that either.
Yeah, correct. And the second thing is, which is a really powerful thing that we're leaning into from an advice perspective, is this is an asset that does not form part of your estate. So it's a non-estate asset. Yeah. And that it's easy to get lost in that statement. Let me just dig a little bit deeper. Essentially, if you've got a blended family or a particular family circumstance that you're trying to think about, how do you manage your estate planning, you tend to lose control, just with the legal system, the way that, your assets can get contested and sort of what that looks like and things like that. We tend to talk about, assets in things like superannuation because that doesn't form part of your estate. But something like this, is a non-estate asset. So essentially, if you're trying to achieve a certain outcome with your estate planning, you can use this as a vehicle, knowing full well that it can't be contested and it's not part of your estate. So it just, whatever the instructions are. So we're seeing this increasingly being used not only as an investment vehicle, but a vehicle to be able to transfer wealth to the next generation on someone's passing.
Yeah. And the other thing sort of to add on top of that is you talk about asset protection. I mean, you kind of think of it, and this is a very generalized statement because it never works quite as simply as this, but you talk about hierarchy of asset vehicles that will protect your assets in the event that, liquidators or, your business were to suffer an event or anything like that were to happen. The first, top of the food chain in terms of best asset that you can hold your assets in for an asset protection perspective is superannuation. Your next best is an investment bond. So your ability to not only protect your assets in the event of your passing and make sure that your wishes, get passed on to whom you wish, from an estate planning perspective is great, but also from an asset protection side of things, it can also be a really fantastic vehicle. That being said, I think one of the important things to note within all of this as well is when we talk about asset protection, when we talk about estate planning, we are talking about things in the event of, you being sued, liquidators coming in, your passing. Separation does not form part of this equation. It's a very, very common question, and people are wanting to protect their assets in the event of separation and trying to find ways that they can move money into certain asset sectors that, in essence, exempt assets. It doesn't exist, and family law courts will absolutely obliterate anything. So it still forms part of your asset pool in the event of a separation. So there is, unfortunately, other than obviously engaging with a lawyer and looking at prenuptial agreements and things like that, this doesn't form part of the protection for that. I think that's an important thing to note.
I mean, look, family law trumps pretty much everything anyway. So, I mean, look, there's some fantastic advantages to these which we've highlighted. I mean, look, I'm fascinated. We're obviously in the industry, but these are not well-known products that are available.
I never think they're like slightly known products that are available. They're not on, unless, I mean, at least in my experience, unless you're an advisor, they're just not within anyone's purview.
Yeah. No, I tend to think that these are, people are exposed to this type of investment opportunity through advisors. Yeah, it's not necessarily something, people are familiar with things like, family trusts and different structures and the like, but yeah, something like this, tend to be right. But look, on the positive sides, there are a few things that we need to call out that can be positive and also negative as well too. I think that's important. The first one that we spoke about was that 10-year, it's called the 10-year rule. So if you want to maximize the tax status of the investment, you need to hold it for at least a period of 10 years. You can hold it for longer. There's no issues with that. So that, like I said, can be perceived as a negative, but you can also see that as a positive as well too. So I think that's important to call out, that when you're considering something like this, you really need to approach it like you should be with most of your investment decisions, being really specific about your investment time horizon as well too.
Yeah.
But I think on one hand, where you could perceive it as a negative, you could actually flip that and say, no, this is actually a positive.
Yeah. And look, similarly, when you're talking about the 125% rule as well.
Yeah.
So 125% rule is that in these investments, because you are getting tax benefits associated with it, your contributions in a particular year cannot be more than 125% of the previous year. So breaking that down a little bit, let's say in year one, you contribute $1,000 towards this investment. Mm-hmm. In year two, your maximum amount that you can contribute is 125% of $1,000, so $1,250. Mm-hmm. Let's say in this scenario, you contribute nothing in year three.
Yep.
Well, then year four, you can never contribute to it again because 125% of zero is zero. Yeah. So it's not based off any of the, culmination of the previous years that you've done, just the one prior year to when you're, looking at making another 125% on top of that.
Yeah, and just to clarify, we're not talking calendar year, we're not talking financial year, we're talking the date that the bond is open. You're talking about the 12-month anniversary, right? So there's an interesting concept, because you're right. If you don't get it right, and this is where the advice piece comes in, but if you don't get it right and you, don't anticipate your cash flow, or you don't contribute 5 years into the bond, you've effectively lost your ability to be able to put anything additional in. So that's a negative. You could also say that 125% of the previous year's contribution is a negative as well too, because if you wanted to put more in, you can't. The other thing that I tend to think about is I flip it on its head. We had this, when our kids were much younger, we were using this type of investment product to save for their secondary school fees.
Well, you've already ruined the point now about what are some of the use cases of it.
What I was going to say is that it put, I guess, positive pressure on us to make sure that we found the cash flow in order to contribute each and every year.
Yeah.
Whereas, an investment that didn't have that sort of structure, if you were under cash flow pressure or, you needed the money for something else, maybe you could pause your investment strategy and then come back to it when things were different.
Well, this forces you to be on the track, continuing to contribute. And I think it's really beneficial because where we see a lot of people falter in terms of their investment journey is something's happened which may not be part of their control.
Yep.
They've needed to put a pause or even potentially pull money out or do whatnot. And then even though that thing's been resolved, it's just getting back into the motion of doing things again, getting back into the motion of contributing again is always a much harder slog. Whereas the people that are just set, forget, and irrespective of what's happening, they just make it work. It can be a very beneficial part of this of just keeping you on the road and keeping you disciplined.
So on that note, the 125% rule, that could be perceived as a positive and as a negative. And probably just the only other thing that I want to talk about before we jump into some of the used cases is that if you plan this out correctly and you think about, in year one, you contribute $1,000 and then in year two, $1,250, and then in year three, $1,500, and then so on and so forth. I can't do the maths past that quickly first thing in the morning. But if you think about what your contributions need to be each and every year, maximizing the 125, you have to project out what your income is, what your contributions are going to be. But even more so, looking maybe 10 years down the track and estimating how much you want to contribute and then working that back within the parameters of the contribution strategy. In saying that, if you wanted to put in, a set amount each week, each month, and keep it like that consistent for 10 years, you can do that as well too.
Yeah. So what Billy's saying is you don't need to go up by 125% a year. You could keep it at, let's say, $1,000 a year and keep it at that for the entire period of time and not make any growth.
Yeah. Yeah, correct. But above and beyond that, it was also saying, okay, if you are going to, if you want to use it for, as an example, in 10 years' time, I want to be in a position to pay off my child's HECS debt. Yep. I don't know. You're going to need $100,000, picking numbers out of thin air, right? You're going to then need to back calculate and say, okay, in order to do that, I'm going to need to contribute X with an anticipated rate of return. So my point is really thinking about what you're going to use it for down the track almost helps set your contribution strategy at the start. And really, from our perspective, not only assessing somebody's circumstance around whether or not this is appropriate, but whether or not or what the contribution strategy needs to be for the goal that you're going to achieve at the end of it.
Yeah. And so perfect use case, right? So I'll share the info. I've recently had a child or, 18-month-old child. We're looking to send her to private school in year 7. And that's one of the things that we want to do for her. Going to need approximately, in today's dollars, $250,000 to take you from year 7 to year 12. So we know the amount that we're going to need for, various schools in the area. Okay, $250,000 is the amount that we want the growth bond or the investment bond to end up with. Mm-hmm. Okay, well, work it back. How much do your contributions need to be per month in order to be able to get to that dollar amount? Worked out to be about $600 a month. So when you think about it, and this is maybe the perfect use case, right? So you look at, okay, what's your projected growth rate going to be? There's no capital gains that you need to account for at the end of it. Not only, okay, what do we need to do in order to be able to have an amount of money to pay for something, but you look at, from my perspective, what's going to be easier? Waiting say, 10 or 11 or 12 or 13 years and saying, okay, in 13 years' time, I'm going to need to fund 20 to 25 grand a year every single year from my cash flow in order to pay for private school fees? Or do you look at it and say, okay, well, is it easier just today to put $600 a month away?
Yeah.
And then I don't even need to think about it in, 12 or 13 years.
Yeah.
It's there, it's done, I know with certainty. And even if your projections are slightly off, even if school fees increase a little bit, it's fine, because you will be able to find that little bit in terms of a difference.
You've done all the hard work.
Because you've done all the hard work, the funds are all there. So it's not only an investment piece, it's not only a piece that's tax effective, it's not only funding what you want to fund, but it's also peace of mind that you know that it will be there. And even if it's not there 100% and it's only there 90%, well, then finding that 10% is going to be a lot easier than finding the 100% at a future point in time.
No doubt. I mean, look, really great used case in terms of, one of the aspects that we think about when recommending these particular types of these products. Another one that we mentioned before is higher income earners. So if your income tax rate is above 30%, that's definitely a consideration because of the tax effectiveness of it. So I reckon there's two really good used cases from that perspective.
Yeah, and then even just from an investment perspective, I mean, for some clients, you're not utilizing it necessarily for just, a specific amount of money, but to grow your overall wealth.
Yep.
So let's consider, we'll just use a random number, right? And let's say you've got, a couple of grand a month that you want to invest.
Mm-hmm.
Well, one of the considerations is, okay, do I take $2,000 a month, invest it in, pick what you want to invest it in, right? A bundle of shares, and all of the dividends that's associated with it's on my personal income tax rate, and all of the capital growth that's associated with it is taxed at, a marginal rate of tax? Or do you maybe split it and say, rather than taking $2,000 and doing all of it in a share portfolio, do I say, okay, $1,000 a month, I'm going to put into just a regular share portfolio. $1,000 a month, I'm going to put towards an investment bond. Your investment bond, because of that 125% rule, becomes that fixed portion that you put each and every single month, and you make sure that you never do, any less than that $1,000 per month. And that other $1,000 per month that's going to the share portfolio, that's your variable portion. So you get a bonus. Yeah. Cool. Let's put, a lump sum amount of money in there. You get, or your income is tight. Okay, well then let's reduce that one a little bit. So you've almost got the other investments, other variable portion that's going up and down as your circumstances change. And the investment bond is the fixed portion that you're going to do 100% and take advantage of all the tax benefits associated with that as well.
Yep. No, love it. Regular and predictable income because of the 125% rule. So, that was a good example of a way you can sort of blend that. But if you've got that, it increases the certainty in our minds anyway that you can contribute to the investment on that regular basis, knowing that you've got flexibility to be able to meet, or as close to as possible, at least, I guess, as a minimum, 100% of your previous year's contributions, but it could lead to 125%. So I think from that perspective, regular and predictable income is also another tick from our perspective. Blended families. So I spoke about the estate planning piece before, but from a blended family perspective, trying to figure out how you sort of help and assist everybody in a certain way while taking into consideration the family circumstances is challenging, and you need to get a bit creative in your thinking around that. And I think that this is a perfect vehicle to consider when we're talking about estate planning. Like we said, it's a non-estate asset, so that sort of bypasses and sidesteps the estate and your will.
Yeah, absolutely. Bills, some of the investment options, I mean, you consider, what this is, how this looks, huge, upside from a tax perspective, from an estate planning perspective, asset protection. But what are the options? Like how's the money invested? Is it all the same? How much flexibility do you have with it?
Yeah, look, there's the investment menus on these products, and there's probably two main product providers. We're not going to talk about names or anything like that, but there's probably two main product providers. They're constantly expanding their investment menus, which is fantastic. But there's probably sort of two streams that I'd like to point out. You've got, I guess, your traditional multi-asset types of funds where you can invest in a diversified portfolio and it will give you access to, Australian shares, international shares, different asset classes. So it's one investment option that basically does a whole range of things for you. That could be a blend of, or that could be an index style fund, or it could be an active style fund, or it could be a combination of both. The other option that we're starting to see is single sector type of ETF funds. So if you've got a particular desire to only invest in, the Australian Stock Exchange, you can pick that in particular.
Yeah.
But with these things, I think the majority of what we see on the investment menus is a multi-asset type of fund.
Yeah. Cost is another consideration as well. So different providers will also have a different cost that's associated with it. So usually what we're looking at is, okay, what's the investment strategy? What's the time frame? How much are we looking to put in there? And then putting it all together and saying, okay, well, based off the parameters that we're given and the cost that's associated with each of the investment bonds, this is going to be the best product for a particular client. But usually that comes as a consideration once you know all of the other parameters around setting this up.
Yeah, and look, considering what you're getting, and I know obviously cost is always a consideration, but considering what you're getting in terms of access to that, they're not expensive.
No,
when you look at the cost, in terms of what you're getting, and I guess probably the last thing I'd pivot into is with something like this, there's a little bit of complexity with it, as we've pointed out. And if you can really get that piece right, these are really powerful tools for a range of different things. But we say it all the time, you need to get advice in order to help shape this.
Yeah, absolutely.
Because if you get it wrong, you could waste, a period of time. And if you're not careful, you can kill the bond. We've seen that happen before if you don't contribute. But yeah, definitely getting advice, figuring out what your strategy is, and then somebody keeping you on track, making sure that you're doing what you need to do in order to keep the thing operating and working as it's intended to is critical.
Absolutely. Bills, I think that puts a nice bow around it, a little bit of an ode to, Christmas in wrapping a bow around it. But no, thank you, Bills. It was, I think, a great episode in highlighting something that's not within everyone's purview. Yeah. And yeah, couldn't speak more highly about some of the power in utilizing some of these products on your own investment journey or your own just event planning journey. So Bills, thanks for jumping on another podcast. It's always a bit of fun jumping on. Thanks to all of our listeners and our viewers for tuning in, and look forward to catching you on the next one.
Like and subscribe, and we'll catch you then. Thanks.
Thanks for listening today. If you have any questions on what we talked about or would like to have a chat about your money journey, visit us at 360fs.com.au.
Just a reminder to our listeners that the information contained in this podcast is general in nature and is not intended as personal recommendations for the audience. Please consider whether the information suits your circumstances before acting on it. This information is provided by Billy Amarinas and Andrew Nicolou of 360 Financial Strategists Proprietary Limited, authorised representatives and credit representatives of AMP Financial Planning.